If you're a business owner and someone asks you, what's your equity? Would you be able to answer that right now? Most business owners could tell you their revenue, they could even tell you your profit, but most struggle when it comes to understanding what their owner's equity really is. And that owner's equity is telling you the wealth that the owner is building. Welcome back to the channel. I'm Joe, a licensed certified public accountant with over 10 years experience in corporate and public accounting. I have an extensive background in accounting, audits, and taxes. And I'm all about helping you take control of your money by living smarter. Be sure to subscribe to the YouTube channel and turn on all notifications. And check out the blog site where we post every Monday, Wednesday, and Friday. In today's video, I'm going to break down owner's equity in simple terms, explain why it matters, and show you how to strengthen it so your business builds real, long-term value. So let's get into it. Owner's equity is simply this: assets minus liabilities equals owner's equity. That's it. It's that simple. Now, what are assets? Assets are everything that your business owns. These are the bank accounts, that cash, equipment, any inventory, your accounts receivable, and all the property. What are the liabilities? These are everything that your business owes. Think of loans, credit cards, vendor bills, payroll taxes, and lines of credits. Whatever's left over after subtracting what you owe from what you own, that's your equity. Here's an example. If your business has $50,000 in assets and $330,000 in liabilities, your owner's equity is $20,000. That $20,000 represents your ownership value. Think of it like owning a home. If your house is worth $400,000 and you owe $250,000 on the mortgage, your equity is $150,000. The same concept applies to your business. Now, here's the part that most people overlook. Revenue doesn't equal wealth. Profit alone don't equal wealth. Equity equals wealth. Owner's equity tells you what your business is actually worth, whether you're managing debt responsibly, whether you're building something sustainable or just generating income. If you sold your business today and paid off all the debt, equity is roughly what you'd walk away with. If equity grows year over year, you're building value. If it shrinks, that's a red flag. Owner's equity isn't just a random number that shows up. It's made up of three primary components. The three components that make up owner's equity is owner's contribution, retained earnings, and owner's distribution. Let's break down all three a little further. Owner's contributions. This is the money or asset you personally invest into the business. If you start your business with $50,000, that increases equity by $50,000. If you later inject another $20,000 to help growth, equity increases again. Retained earnings. This is the accumulated profits that stay in the business. Let's say your business earned $100,000 in profit this year. If you take $70,000 as a distribution and leave $30,000 in the business, that $30,000 increases your equity. Over time, retained earnings are what truly build a business's value. And lastly, owner's draw or distribution. This is the money you take out of the business. Important point, distributions are not expenses. They do not reduce profit. They reduce equity. If you constantly pull out more than your business earns, equity will shrink. And that's where many business owners unknowingly weaken their financial foundation. Depending on your entity structure, equity might look a little different. If you're a sole proprietor, it's going to show your equity as owner's capital. If you're in some sort of partnerships, they track separate capital accounts for each partner. And if you're set up as an S corporation, it's going to show it as shareholders' equity. And for a C corporation, this is going to include your paid-in capital and retained earnings. The terminology changes, but the core concept remains the same. It reflects ownership's values. So, what are the things that are going to help to increase your owner's equity? Here are some things that can help to increase that equity. The business earns consistent profits. You reinvest profits instead of distributing everything. You pay down the business debts. Assets increase without increasing any liabilities or taking on any additional loans. Strategic growth builds equity. For example, if you take on debt to buy equipment that generates higher revenue and profit, and you manage that debt properly, your equity can increase over time. Not all debt is bad debt. Mismanaged debt is bad. So, let's take a look at the other side of the coin. What are some things that can decrease your owner's equity? Equity decreases when the business operates at a loss. You take excessive distributions. Liabilities increase faster than assets. Major write-offs or asset losses occurs. A temporary dip isn't always alarming, but a pattern of declining equity is something you should address immediately. Here are three of the most common mistakes I see made by business owners when it comes to their equity. Mistake number one is confusing cash with profit. You can be profitable and still have low cash because customers haven't paid yet, you invested heavily in inventory, you purchased equipment. Profits affect equity, cash affects liquidity. They are not the same thing. Mistake number two is pulling out too much money. If you're constantly withdrawing more than your business earns, you're slowly draining equity. That weakens your balance sheet and can hurt future borrowing ability. And finally, mistake number three is ignoring the balance sheet. Many owners only review their income statement, but your balance sheet tells whether you're building something strong or fragile. If you want to intentionally grow your equity, here are some practical steps. Number one, retain a portion of a profit each year. Number two, reduce high interest debt strategically. Number three, improve receivable collections. This just simply means collecting on those receivables from customers that owe you money. Number four, invest in productive assets. Number five, reviewing your balance sheet quarterly, not just at tax time. Equity growth should be intentional. So, here's the bottom line: revenue is activity, profit is performance, but equity is ownership value. If your goal is long term wealth, financial independence, or eventually selling your business, you must understand and monitor your owner's equity. It's not just an accounting term, it's the scoreboard of the value you're building. If this video helped to clarify things for you, be sure to like and subscribe for more practical business and financial guidance. And remember, build profits but protect your equity growth. And join me next week, we will break down choosing a business entity structure and the tax implication behind it.